What's up everyone, it's Karthik with MoneyVest. So in this video we are going to be talking about the S&P 500. I have done some more analysis and more data has been extrapolated on the S&P 500 and go over some other really important updates. Looks like Hindenburg Research is coming out with yet another hit on the Indian company Adani Group. And this right here was the most recent 3 hours ago report that they published, which is a super long paper on the Adani company, Adani Group. We know that Gautam Adani is the CEO owner of Adani Industries, and they have a lot of publicly traded companies. And this report essentially alleges that there's been stock manipulation, there's been siphoning scandal around transactions and overseas transactions through multiple layers of different companies and holdings. And they essentially tweeted 20 hours ago something big soon, India. And this right here is the report from 3 hours ago, which is most certainly going to rattle the markets a little bit on Monday, especially the Indian stock market, because we did witness over a 76% sell-off in the Adani Group. So if you come over to Adani Industries, and again, a lot of you may not know what this company is or what this company actually does. And if you come over to the monthly time frame, Hindenburg Research, very much known for short reports and shorting the stock, many stocks here. So this right here was the report that came out in January of 2023 when the stock price was trading just under 4,200 rupees, and it traded down over 67. At one point was down over 75% in just 2 months after the report came out, trading down to 1,000 rupees here. And obviously we did see a pretty nice reasonable recovery of over 200%, but this is yet another extension of that report, which they mentioned our 18 months of further investigation. And they've also taken hits at the SEBI, which is the government agency that is essentially the counterpart of SEC, Securities Exchange Commission. SEBI oversees all equity markets over in India. So taking a little bit of a hit over there as well. So we'll see how the markets react and respond, going into next week here. But S&P 500 back in January of 23 didn't really see a big impact. You'll notice that January 2023, we're over here, up over 6%. The following month, February of 23, we were slightly down about 2.5%. But December 22, we were down over 6%, but we were also coming off of the bear market of 2022. So I don't expect this to be a big catalyst for the US markets, but definitely this is huge for Indian markets. Now moving over, so this right here again is the entire report published August 10th, 2024. People can read it if they want, but this right here is the percentage of bulls in the Investors Intelligence Sentiment Index, moving down to over 17% in the past 2 weeks. This is from Charlie Belio, shout out to him, posting it on X. We came down to 46.9. That is the Investor Intelligence survey, or percentage of bulls, which obviously did drop to quite significant levels from back in April of 2024 as well. Something very similar to what we witnessed for when we also saw a dip over here, which was yet another buying opportunity. And from 64.2% to 46.9%, that's the biggest 2-week percentage drop in bulls since October of 1987. So this is the fastest magnitude of this drop here that we witnessed in last week here, considering how much selling pressure there was for the entire market. So 2 weeks ago, bullish sentiment was an extreme, higher than 97% of historical readings. After the 10% pullback, it's moved back to a normal 52nd percentile. So we are already trading at a bit of an extreme here at over 64.2. Now, MoneyVest Index has also seen a very similar drawdown in the, of course, reading here, as similar to what we witnessed for the S&P 500, the intelligence survey. This right here was back in October of 2023. This right here was back in April of 2024, and this right here is August of 2024. So you'll notice that we actually came down to a very nice comfortable level of 3. We were trading as high as 4.5. As you can see, that was the high level for the MoneyVest Index, and the couple times we've traded down to as low as 2. Those have always been a very good buying opportunity. This was the extreme of 2020, so we traded all the way down to as low as 1.5 to be precise. If you essentially go all the way across, that was the level. And again, we've not really seen 1.5, let alone 2 from those levels ever since, right? So every time this comes down, it is a huge buying opportunity in my opinion, as I continue to highlight the idea. It's built on very many technical indicators, market breadth, volatility. There's a lot of equations and calculations that go into creating something like the Money Vest Index, which again trades at a reading of 3.4 right now, circling back up after the rally that we saw on Thursday and Friday. Now, this right here is from today, so August 10th, just a few hours ago. Fed's Bowen says the rate cuts will be needed if inflation keeps falling. So she essentially says Michelle Bowen softened her usually hawkish tone ever so slightly on Saturday, noting that some further welcoming progress on inflation in the last couple of months, even as she said inflation remains uncomfortably above the central bank's 2% target. Subject to upside risks. She says, and I quote, should the incoming data continue to show that inflation is moving sustainably towards our 2% goal, it will become appropriate to gradually lower interest rates to prevent monetary policy from becoming overly restrictive on economic activity and employment. But we need to be patient and avoid undermining continued progress on lowering inflation by overreacting to any single data point. And as I mentioned before, the Federal Reserve is going to be very much focused on bringing inflation down more than risking getting the economy into a recession or unemployment pushing higher. Because as I've mentioned before, the risk of cutting too early is far greater than the risk of cutting too late. Always remember that from a monetary policy standpoint. If you ever become the chairman of the Federal Reserve, remember that the risk of cutting too early is always going to be greater than the risk of cutting too late. And the reason for that is very simple. Once you start increasing interest rates, it's not like you can do that overnight. It's a process that takes a long time, many, many months, many years to get interest rates to where they are. And you don't want to prematurely start cutting interest rates because that results in a couple things. Number one, it's going to take longer to get rates back up because it's not an overnight thing. And number two, if inflation starts to reaccelerate, that is going to be a much bigger problem and more difficult to solve than if the economy enters a recession or unemployment starts moving up, because rate cuts happen faster than rate increases. So that's exactly why if rate increases happen slower than rate cuts, then they want to move to rate cuts rather slowly, and they want to think properly before they start cutting interest rates. They can move a lot more proactively for cutting interest rates because that is going to happen with a snap of a finger. But increasing interest rates definitely takes a lot of thought process, a lot of decision making, a lot of discussion and debate before they can actually do that. So that's why they are moving very slowly and steadily and cautiously to cut interest rates, because they know that once they cut rates, it's going to be very difficult to not only move rates higher, to justify them, to make them make sense. So that's why they're moving a lot more cautiously. They can cut interest rates tomorrow if they wanted to. So that's why the increasing part takes a bit more time. And right now we've got 51% probability of the market expecting a 25 basis points rate cut. We're kind of fluctuating between 49 and 51% for 25 to as many as 50 basis points rate cut. So those right there are the two probabilities. The market's obviously not pricing in for rates staying where they are. They are expecting rate cuts in the tune of anywhere between 25 to as much as 50 basis points of cuts, and then a 49% probability that we're going to be seeing rates down to 4.5 to 4.75% by the time my birthday, and by the end of this year, we're talking December 2024, the markets are pricing in for rates to be down even more to 4.25 and 4.5% by December meeting of 2024. So those are very optimistic assumptions. If you really consider, where we are with interest rates, we are at 5.25 and 5.5%, and for the markets pricing in for 4.25 and 4.5%, it's 100 basis points or 4 rate cuts that the markets are currently pricing in at the moment. Now, coming over to some technical analysis on the S&P 500, just a few more things that I wanted to break down in this video. I'm actually working on another analysis that's strictly going to be going over the 21 exponential moving averages. You can see over here on the daily chart, the 21 EMA is going to be in white. So we're going to be doing some analysis, some data analytics on the very fact that every time you've seen a breakdown below the 21 EMA, how long has the markets taken to recover back to see that crossover back above that 21 EMA? And once we've broken down versus once we have crossed above, what's been the average return for the market? Because this in itself is a very good strategy. It's got a pretty decent win rate. If you simply just buy on the price crossing over the 21 EMA and, of course, selling on its cross below the 21 EMA, it's worked out to be very, very good. As you'll notice at this right here, a couple times, we've seen the markets sort of rotate below the 21 EMA. Then, of course, we've started to trade in this downtrending channel. And this right here has once again been the uptrend, and we've seen the markets rally higher. This right here, again, a little bit of a crossover above that 21 EMA. Nice little uptrend. Again, you can see a bit of a crossover above the 21 EMA. Nice little rally over here. A couple times we've gotten that fake outs. So, for example, here, this also turning out to be a very good trade, pushing up to that new highs, not really the all-time highs, but of course a decent high. And this right here, of course, the overall trend for the 21 EMA. And every time we've crossed below, again, you can see the lower highs and lower lows. This right here, crossing below that 21 EMA, coming down. And more recently also, we crossed below that 21 EMA, that's the white line, and we sold off. And now we're starting to move back higher. So that is going to be an analysis that I do in my next video. I'm actually working on the data now, but I've got something else for you, which is going to be the win streak versus the loss streak for S&P 500. So this is going back as far as 51 years again. So we're looking at almost 13,000 days worth of data, of which green days were 6,819, red days were 6,000. The longest winning streak was 12 days for the S&P 500, and the longest losing streak was 10 days. So that again gives you a bit of an idea and a perspective that the longest consecutive daily winning streak, green days in a row, we've seen are 12, and the longest streak for consecutive losing days or red days we've seen is 10. And the probabilities are going to be right over here. Got the 1 day win streak, 2 days win streak, 3 days, 4 days, 5 days, so on and so forth. Only one occurrence of the 12-day win streak. From the S&P 500, we've seen 3 instances of 11 days of consecutive green, 5 instances of 10 days of consecutive green, and right now, as you'll notice, that we are all the way at the bottom. So let me just fix this data. I'm going to remove all the different filters, and we come all the way down. We are looking at the markets on 8/8 to be up over 2. No, I got still some filters here. Let me just update that. I was like tripping. I was like, wait, that doesn't make any sense. Okay, there we go. So we got 2 consecutive days of green from the markets on August 8th and August 9th. And right now we're in the 2-day streak at the moment for S&P 500. So we're still within here, which we've already seen 1,700 times play out, or 25.6% of the times. So the higher the markets go next week, let's say that we see 2 more days or 3 more days of green, Monday, Tuesday, Wednesday, for example, then we're going to move into 3 days, 4 days, and 5 days, and the probability for us to see more and more green higher is going to diminish over time because it is going to become more and more rare. And that's what this analysis shows us, and this is on the way down, of course, in terms of the red days that we have witnessed for the S&P 500. So really what this shows you is that after 6 days of consecutive red, there's bound to be a bounce in the S&P 500 because the rarity of us to see more red diminishes significantly down to less than 1%. 7 days of consecutive red, that's only happened 24 instances or occurrence of this streak, and that's less than 0.5%. So extremely rare for us to see 7 straight days of red in the market, let alone 8 days, 9 days, 10 days becomes even more rare for the market here. So that again is going to be the overall breakdown of the streaks, the green streaks and the red streaks for S&P 500. And again, we're going to be talking a little bit more in detail with regards to the 21 EMA and how that has acted as a very strong area of resistance or support, and of course buying or selling signal for the markets as well. So a couple things I want to mention is that extremely oversold RSI and MACD, something that we haven't really witnessed since April of 2024. The last time prior to that was back in October of 23, and prior to that was around this level. Was in October 23, and then of course once again during the August 23 sell-off, and this right here during March of 23 sell-off. So every single time we've seen the RSI come down to some very, very attractive levels, and that's corresponded well with the S&P 500. So this right here is April 2024, and this right here is where we are at the moment. And again, all of these have been pretty good, pretty reliable signals to dollar cost average and of course buy back into the market. Not saying that this can't get any further in terms of that correction or bear market territory. It certainly can, because you'll notice there's been a lot of discrepancies. For example, if you take a look at January of 2022, was the market's already down, I think, in a correction. The RSI was incredibly oversold. And then guess what? The markets continue to sell off even further. So it doesn't mean that we can't go lower. We certainly can. We, of course, bottomed out all the way down to 360s here. It was down over 27% from our all-time high. So RSI in itself, in isolation, is not the best indicator, but it has to be combined with a lot of other indicators so we can have a much better holistic overview of the entire market technicals moving forward. So that's where we are. Hope you all enjoyed this video and a quick update on the entire market sort of updates and analysis here. I'm going to be working on some other data sets to present to you tomorrow. But in the meantime, again, keep a close eye on some of these levels that we've already identified in our other updates. And from a streak standpoint, we are 2 days in for this green streak that we're witnessing for the market. So hope you all enjoyed this video, found it helpful. Make sure that you drop a like and share this video with other people, investors, traders that you feel are going to find this video to be valuable and helpful. I would love to know that. If you have any questions, let me know in the comment section down below. As always, happy investing. I'll see you all in the next video.